you so much for joining. This video is an introduction to weighted average cost of capital, and I would like to explain you the key items of the formula that we use for valuation purposes. First, again, I talked about this in another video, we always use weighted average cost of capital interchangeably with R for return. The reason is cost is from a company perspective, return is from an investor perspective, but it is exactly the same. If you're an investor, let's assume you are a shareholder, common shareholder, and you are lending the company money because you bought shares. There's a risk involved depending on the riskiness of the business, the industry, because you wait for your money to get it back at a later point in time. You may say, okay, I invest $100 in the company as common shareholder and I expect a 10% return. Then your return on equity would be 10%. From a company perspective, if they would borrow $100 from you as an investor, they would need to pay 10% interest. So from a company perspective, it is the cost. Yeah, same for a preferred shareholder, RP, preferred shareholder. If they would lend 100 because the investor bought preferred shares, they would potentially lend the money 100 at a rate, let's say 8%. Yeah, from a company perspective, it's a cost to raise $100 via preferred shares. They would need to pay $8, 8%. Same for a debt holder. If a debt holder, an investor would buy $100 in bonds, would potentially ask for like 5%. Yeah. So if a company would raise debt because it needs money and would borrow 100 from debt holders, their cost would be 5%. From an investor perspective, the return would be 5%. Yeah, and then depending on what the proportion is of debt, preferred shares and common shares, then basically the mix of 5%, 8%, 10% is your weighted average cost of capital. If the company has a 100% equity structure and only consists of common shareholders, then your weighted average cost of capital would be your cost of equity only. You wouldn't have the debt part and you wouldn't have the preferred share part. Yeah, so it shifts depending on how much weight you have from each capital provider. Very important here, as you can see, from an investor perspective, equity is more risky because if the company goes bankrupt, you get your money last. Preferred shares are not as risky as common shares, but more risky than debt, because what happens is there's a liquidation process and a ranking. That's why you can see in general it goes something like this. Debt holders don't bear as much risk as preferred shareholders, as common shareholders. That's why the return needs to reflect the risk. One addition, because as you know, debt is tax deductible, we need to look at the after-tax return on debt or cost of debt. Yeah, very important. Good. So the firm's cost of capital is the weighted average cost of capital. It is the average return for the average systematic risk of the firm. We assume an investor is well diversified and the only risk an investor has to bear or has to request return for is the systematic risk. And then as mentioned, it's also called the aggregate return of the capital invested in the firm's security, bonds, common shares, preferred shares. Yeah, and we use this to discount the free cash flows of the firm. So once we calculate our free cash flow to both debt holders and equity holders, we would use weighted average cost of capital as discount rate. If we calculate free cash flow to equity holders, then we would not include this and we would use, depending on what the equity structure is, we would discount at 10%. Yeah? Good. What else? This is the first part, so this is the underlying cost. Here I have made another video, capital asset pricing model or dividend discount model. Here you can use something similar, a perpetuity formula, and cost of debt is a bit more tricky. You can use yield to maturity measures or more complex spot rates. I have done a video on capital asset pricing model and DDM. We'll do some other videos on the other measures. So here there are some methods how to calculate your return. This one is weight, and this really means how much which source, financial source, capital source the company has. If it has 100,000 and then it has 30k debt, 10k, 60k common equity, then you can see the percentage right away, 10%, 60%. So what you would do, you would input here 30%, here 10%, and here 60%. One important thing is, where do you get the numbers from? If you look at shareholders, preferred shareholders, debt holders, one thing would be to look at the balance sheet and see, okay, I just look how much debt is outstanding and how much equity is recorded on the balance sheet. We don't do this in finance. We are not using book values. We use market values, because everything we do with discounting and free cash flow is forward looking. It's not backwards looking, it's not accounting, it's forward looking. Whenever we do something in finance that is forward looking, we use market values. So for the debt part, market value of debt, there are different ways to do it. Number of bonds times current price of bonds, market value of preferred shares, again, number of shares, preferred shares times share price. And for equity, common equity, it would be the same. Market value of common shares or equity would be number of common shares times share price. Yeah, I will explain in more detail how to calculate, because especially for the debt part, sometimes it's not easy to identify, okay, what is the price of a bond? and if there's a more complex debt structure, how to get the weight. But in general, as an idea, we use market values, we don't use book values. Yes, that's an introduction. I hope you found this useful. Thank you so much for listening, and see you later.